Most people think investing is complicated. They imagine staring at charts all day, watching red and green numbers move, trying to guess the perfect moment to buy or sell. And for many beginners, that complexity becomes the reason they never start. Because when something feels confusing, the brain does something predictable. It delays the decision. You tell yourself you'll learn about investing later. Next month. Next year. When you have more time. But here's the strange part. The people quietly building wealth aren't necessarily smarter investors. They're just using systems that remove most of the thinking. Systems that automatically invest money, automatically reinvest dividends, and automatically grow portfolios in the background. And today, something even more interesting is happening. Artificial intelligence is starting to automate parts of the investing process that used to require constant manual effort. Which means building a dividend portfolio can now look very different than it did 10 years ago. In fact, you can set up a system that automatically builds income-producing investments with minimal effort. And one of the easiest tools to do that is a platform called M1 Finance. But here's where it gets interesting. When you combine automation, dividend investing, and AI-assisted research, you create something powerful. A portfolio that quietly compounds while you focus on your life. The hidden insight most beginners miss. Most people approach investing like it's a daily activity. Checking prices, watching news, reacting to market swings. But long-term investors think differently. They focus less on daily price movement, and more on building systems that work automatically. Because wealth rarely comes from perfect timing. It comes from consistent processes repeated over long periods of time. Dividend investing is one of those processes. Instead of trying to predict which stock will double next month, you focus on companies that regularly distribute profits to shareholders. These payments are called dividends. And when those dividends get reinvested automatically, something powerful starts happening. Your money begins buying more assets on its own. Over time, those assets produce even more dividends, which buy even more shares. This cycle is called compounding. And when automation enters the equation, compounding becomes almost effortless. The psychology of automated investing. Here's something interesting about the human brain. We are terrible at consistency when emotions are involved. Markets go down, we panic. Markets go up, we chase excitement. News headlines create fear. And social media amplifies every market move. But automation changes this dynamic completely. When investing decisions become automated, emotions disappear from the process. Your system continues buying assets whether markets are up or down. And this is where platforms like M1 Finance become incredibly useful. Instead of manually placing trades every week, you design an investing structure once. Then the platform executes the plan automatically, which means your brain is removed from the moment-to-moment decisions. And that's often where better investing outcomes come from. The mathematical advantage of dividend compounding. Now let's look at something simple but powerful. Imagine you invest $500 per month into a dividend portfolio. If that portfolio earns an average return of 8% annually, after 10 years, your investments could grow to around $90,000. But here's where dividend reinvestment becomes interesting. If those dividends are automatically reinvested, your portfolio begins purchasing additional shares regularly, which means the number of income-producing assets keeps growing. Over 20 years, that same consistent investment could grow beyond $300,000. Not because you found a magical stock, but because compounding had enough time to work. This is why automated systems matter. They protect the consistency required for compounding, where AI enters the picture. Now let's talk about AI. Artificial intelligence isn't picking guaranteed winning stocks, but it can do something extremely valuable. It can analyze enormous amounts of financial data faster than any individual investor. Things like earnings growth, dividend history, payout ratios, sector trends, company fundamentals. AI tools can help investors identify companies with stable dividend histories and sustainable financial structures. In other words, instead of manually researching hundreds of companies, AI tools can filter the possibilities. This doesn't replace judgment, but it dramatically speeds up research. And when you combine AI-assisted research with automated investing platforms, you create a powerful workflow. Research becomes faster, execution becomes automatic, and the system runs quietly in the background. Step by step, setting up automated dividend investing in M1 Finance. Now let's walk through how this actually works. Step 1 is creating an account on M1 Finance. Once inside the platform, you'll see something called pies. Think of pies as portfolio blueprints. Each slice represents a different investment. For example, a dividend portfolio might include companies like large consumer brands, utility healthcare companies, or dividend-focused ETFs. Each slice has a percentage allocation. Maybe 10% in one company, 15% in another, 20% in a dividend ETF. The entire pie represents your investment strategy. Once it's created, M1 Finance automatically distributes money into those slices whenever you deposit funds, which means the system constantly maintains your portfolio balance. You don't need to manually calculate anything. The power of automatic dividend reinvestment. Here's where things become even more powerful. When companies pay dividends, M1 Finance can automatically reinvest those payments back into your portfolio. That means every dividend payment becomes new invested capital. Instead of sitting as idle cash, the money continues working. This creates a self-reinforcing cycle. Dividends buy more shares. More shares generate more dividends. And over long periods of time, that feedback loop becomes incredibly powerful. Many investors underestimate how important reinvestment is. But historically, reinvested dividends have accounted for a huge portion of total market returns. Something interesting happens when your investing becomes automated. You stop thinking of investing as a task and start thinking of it as a system. You become someone who builds financial infrastructure. Instead of reacting to markets, you're quietly constructing income streams. Every automatic deposit becomes another brick in the structure. Every reinvested dividend becomes another layer. Over time, the system starts to feel less like investing and more like owning a financial machine, one that slowly produces income-generating assets. Now imagine something else. After several years of consistent investing, your dividend portfolio starts producing meaningful income. Maybe it's $50 per month at first, then $100, then $300. Eventually, that income can start funding new investments. This is where financial options expand. Dividend income can be used to buy additional stocks, invest in new sectors, fund other assets, or build entirely new portfolios. Instead of relying solely on earned income, your assets begin contributing. And that shift changes how you think about money. Because money stops being something you only earn. It becomes something your assets generate. But here's the part many people overlook. As income increases, lifestyle costs often rise with it. New car payments, luxury purchases, expensive subscriptions. Each one quietly absorbs cash flow that could have become invested capital. And over time, those spending decisions compound as well. A $600 monthly car payment invested instead could grow into hundreds of thousands of dollars over decades. This is the hidden opportunity cost behind many financial decisions. Not the price itself, but what that money could have become if invested. Let's look at a simple comparison. Two people earn the same salary. Person A spends most surplus income on lifestyle upgrades. Person B invests consistently into dividend assets using automated systems. 20 years later, their financial realities may look completely different. Person A may still rely entirely on active income. Person B may have built a portfolio generating monthly dividend payments. Both made small decisions along the way. But those decisions compounded in different directions. This is why automated investing systems matter so much. They quietly reinforce the second path. At some point, investing stops feeling like a strategy. It becomes part of your identity. You're no longer someone trying to beat the market. You're someone who builds systems that allow wealth to grow over time. Automation handles consistency. AI accelerates research. And compounding does the heavy lifting. Which means your role becomes surprisingly simple. You continue feeding the system. Month after month. Year after year. Because wealth rarely appears suddenly.